minute they announce anything positive and say the war is about to end and we're negotiating with with Iran now, and then suddenly stocks shoot up. Okay, so maybe, who knows? I mean, Trump does anything's possible with this guy. So maybe he's, keeping prices low so his family can buy all the stock. All right, so let's see here. Moving on. Then people become a bit more rational once more information comes out. That's true. When the war starts and everybody's nervous and no one knows what's going on, that uncertainty alone will drop the price of something. So as information becomes clear, you have a natural reduction of risk because at least you know what you're dealing with. Let's see here. And once they get a sense of actually what's going to happen, Bathgate said, we really didn't know what was going to happen at the weekend, and it was sort of spread out all across the Middle East, even in places like Dubai. So I think now people can become more and more discerning and more as more and more information comes out. Let's see. Bathgate also said European bond yields have been particularly hard hit. Absolutely. Okay, this is more international. Foreign exchange, the foreign exchange market was volatile, so the dollar is a little more valuable right now. Let's see here. Cryptocurrencies got hit. Bitcoin got slammed. Let's see. The broad sell-off came as oil prices continued to spike. Brent crude, the global benchmark, jumped almost 9% to 84.50 a barrel. Let's see here. What else is there that we should know about? That's pretty much it. Oh, here we go. This is interesting. Allen added that sustained S&P 500 drawdowns driven by oil shocks historically required one of three coinciding conditions. So he said historically when they look at S&P 500 declines, that's what a drawdown kind of is pretty much. That occurred because of an oil shock, like something in the Middle East. They typically require one of three coinciding conditions, none of which has yet been met. None of which has yet been met. Okay, interesting. He says they were an oil price. Wait, sorry. So here were the shocks. It looks like that's what they're saying. They were an oil price spike of at least 50% sustained over several months. A shock big enough to tip the economy into recession or cause a meaningful slowdown, or a sharp hawkish pivot from the central banks to fight the inflation arising from elevated oil prices. Okay, so typically he's saying that a sustained drawdown would be a bear market for the most part. So he's basically saying usually the only time you would end up seeing a full-blown bear market, meaning the market going down for a while, is if one of three things were happening at the same time, or not at the same time, but one of these three things were occurring. One, an oil spike of at least 50% sustained over several months. That hasn't happened. The price of oil has gone up a lot, but it hasn't been sustained over several months. Okay, so a prolonged war could do that. Two, a shock big enough to tip the economy into recession. So he says that this shock is not big enough to push us into a recession. Okay. Or three, a sharp hawkish pivot from central banks to fight the inflation arising from elevated oil prices. So what that is the Federal Reserve sees that the price of oil is going up, which means that they have inflation. When there's inflation, they increase interest rates. One of the rules of investing that a lot of traders stick with is they do not fight the Fed. So if you ever hear that the Fed has become hawkish or they're raising interest rates, then you better run for the hills. You better hide your wife, hide your kids, because ain't no money to be made in this market unless you're selling stock options or something else. Because at that point, they are deliberately slowing down the economy in order to control inflation. And historically, when the Fed is doing that, the market has a decline. So that is a buying opportunity. It's not a time you're going to feel good about being an investor unless you're thinking about what's going to happen once they start lowering interest rates again. So just keep that in mind. If the Fed starts hiking, it's a wrap. They're going to mess it up. All right, so let's see here.